Okay, thank you, Chrissy, and welcome everybody to our webinar on the new lease standard. Today is one of the type of webinars that I get excited about because it's just cases. There's a little bit of theory, a little bit of how the standard works in some bullet points and whatnot throughout, but we're primarily going to focus on examples. And so if you're anything like me, this is a great way to learn. And so you think you understand it, but then you get to watch an example all the way through. And we've tried to put together some representative samples of things that we're seeing with any of the people that we work with lease implementation consulting, or getting the companies that we're working with a lot to get ready for adoption. We've had a handful of folks early adopt, and so these are very practical examples, we hope. In any case, I'm very excited about the turnout. We have, over 500 people on the webinar here today, and so this is clearly a topic of interest. I know that there are a lot of you in government and not-for-profit that may be using a different type of standard that is very similar to FASB ASC 842, and so we have heard the demand for GASB 87. We have some internal expertise on that as well. And so you can expect to see some more webinars on GASB 87 coming in the future. But for today's webinar, we're going to focus on the FASB standard. There's a lot of similarities, a drastic amount of similarities, to be honest with you. And so a lot of those concepts will carry over for both, but just know that they may not apply exactly. As Chrissy said, please, if you have some questions or thoughts throughout the webinar today, feel free to put them into the Q&A pod. The presenters are going to be monitoring the Q&A, and we'll try very hard to answer those throughout the broadcast, or if we're not going to address it specifically in the webinar itself. If we don't get to them today, we'll try very hard to reach out individually and get your questions answered. And then before we get started, I'll just say there are many more webinars that we'll be offering as the adoption date gets closer for all of the entities on the line today. So if you have any particular interest in certain topics as it relates to this standard, please let us know that in the survey that's coming out soon as well. All right, without further ado, let us go ahead and get started. The best way, I think, to start is to let you know who's talking to you today. So my name's Jonathan Krapchick. I'm out of our Raleigh office, and I get to do a lot of things in the firm, not the least of which is be in our professional practices group and look at our audit process and methodology. Clearly, the lease standard is going to impact that greatly. I also do look at a lot of our technology solutions within our audit practice, and we'll talk at the end of the webinar today of a technology offering that we have to help clients do some lease maintenance, and we'll do an example of that at the very end. And I'll go ahead and let Jessica and Michael introduce themselves to you real quick too. Jessica?
Hi, I'm Jessica Everidge. I'm a manager in our Atlanta office. I work with our professional practices group as well, so I spend part of my time working directly with clients and then the other part doing things like this, and specifically helping with implementation of 842.
And Michael?
Yes, my name is Michael Hoos. I'm a senior manager out of the Raleigh office. I'm part of professional practices as well, and I spend a good bit of my time answering, real-world questions from different partners and managers, and then the other part of my time developing content like this, and looking forward to talking with you today.
Great. So Jessica and Michael and I have done a lot of work in the 842 world over the past few years, and certainly look forward to doing a lot more. And so let's go ahead and get started with our first example. We're going to start with a fairly simple one, and this one is about the initial measurement of a new lease. So we have a company that is under 842, and then they sign a new lease. What does that accounting look like? And so we'll kind of get the gears turning with this one. So this is just an average building. We have on January 1st, 2020, our favorite company, Uncle Cherry's Widgets and Stuff. They enter into a 10-year lease with Watermelon Realty for just an average office building. So this is very normal. A lot of companies will have this exact same situation happen with them. And just as a caveat for every single example that we're going to go through today, is going to be with Uncle Cherry, and they have adopted 842 in 2019 for every single example. So just know that going into it. Just to recap, this is a 10-year lease. They'll be issuing their 2020 financial statements, which will have comparative years for 2019 and 2020. And we have previous webinars on transition methods and implementation issues, which we'll get into later. All right, so a few more facts with this lease. The commencement date was January 1st, 2020. The lease payments are $1,200 a month, which is fairly inexpensive, with a 3% annual increase. It does have some renewal options on this lease for 5 years, but management is uncertain, so they'll stick with just the 10-year lease. The incremental borrowing rate is 10%. They have some initial direct costs of $5,000, and these are initial direct costs that qualify under ASC 842. There's no transfer of ownership. There are no purchase options. There are no non-lease components. There's no residual value guarantee. This is a very simple lease, a very straightforward real estate lease. Let's go ahead and take a look at the payment schedule. And so we can see here that the payment amount each month is $1,200 bucks. The first year it goes up 3% each of those years, and then the lease finishes on 12/31/2029. Before going into the lease classification, we can go ahead and get this first entry out of the way. And so regardless of whether or not this is an operating lease or a financing lease, we know the very first entry. And so on January 1st, 2020, Uncle Cherry will book this entry that you have on your screen right here. And let me go ahead and get my little spotlight. And so we've got the lease liability, which is simply the minimum lease payments present value to 2020 at that interest rate of 10%, and that is $101,624. Fairly simple. That's going to be our lease liability, as you can see right here. The initial direct cost, which we paid at the commencement date of the lease, is going to be that cash payment of $5,000. And then the right of use asset is just going to be the lease liability plus those initial direct costs. Fairly straightforward example. And so even before we classify the lease as financed or operating, we're going to know the answer to entry number 1. But there are some additional facts that we're going to need to be able to qualify this lease as either a finance or operating. But we can get this thing on the balance sheet regardless. Getting it off the balance sheet, we are going to need to know what the classification is, because that is really the big difference between the two types of leases. Let's say we know that we have this office building and it's got a remaining economic life of 25 years, which is obviously an estimate. And we know we can estimate the fair value of this office space is $450,000. We have our 75% and our 90% tests that are under ASC 840, our current lease standard. That in the background of ASC 842, the FASB assumes most companies are going to choose the 75% and the 90% as the litmus test for classification. But you're welcome to use some other metric if your company feels maybe 70% would be better, or maybe 95% would be better. That is still completely a policy that the company can adopt. The FASB just assumes we're going to stick with the old standard. But by doing this, since both of these are under 75%, and then the present value of the minimum lease payments is underneath 90% of the fair value, we've got ourselves a pretty clear case of an operating lease, and none of the other classifications were met. And with that, we can create this beautiful amortization table. Let me get my little spotlight back. And so we've got our expense that is going to be the same all the way down, as you can see here. So this is very similar to current lease practice. In an operating lease, you're going to have a very little income statement effect. So on the ASC 840, this is going to look very similar to what it's going to look like under 842. And so the expense is going to be straight line throughout the life of the lease. Our payments, we can see, go up every year by that incremental piece. And then this is the different piece. And so even though we don't report separately the principal and interest payments for each one, we still need to track them. And this is really going to be a matter of being able to quantify what this right of use amortization is. And we'll see here as we go to what the entry will look like under the first year, why we need to do this. But this right of use amortization essentially is a plug. And you may realize that the amortization is going up every year. And that's really because if we want to get to a straight line lease expense right here, but we've got this interest portion to get the liability off the balance sheet, this right of use amortization kind of has to increase in conjunction with the interest portion of the liability reduction. And so, knowing all this, we can go ahead and get our second entry right here. And so at the end of the first year, we will go ahead and say we've got our lease liability going to be reduced by the $44.37. We've got our straight line lease expense of $17,008. And then we know we're paying in cash $14,400. And this is why I say that that right of use amortization is a little bit of a plug. Because this has to be $17,008. This has to go down by $4,437. This has to be $14,400. And so this now has no choice but to be $7,045. And then every year after that, you're going to book a similar entry just following down that amortization table, assuming there's no other triggering events to make us revalue the lease. All right. But that's not always going to be the case. And so I'm going to have Jessica talk about if there was a slight change in facts and what that would do to our example.
So let's use the same example that Jonathan just walked through, except we'll just change one thing. So assume that the fair value of the office space is now much less. It's only $110,000 compared to $450,000 before. So the company, as you can see, is probably not getting a very good deal, but the present value of the lease payments is now over 90% of the fair value of the leased asset. So with this change in facts, the company would now classify the lease as a finance lease. So here's the amortization table for the same lease if it were now treated as a finance lease. You'll notice that the totals for each column here are exactly the same as the totals when this was an operating lease. So there's no change in the overall recognition between lease types. The difference is just in the timing of the expenses, and then also where on the P&L the expenses are recorded. So the differences between the finance and the operating lease can really be seen in these two columns. So you'll remember that for the operating lease, the company recognized the single lease expense of $17,000 in each year of the 10-year lease term. But now the total expense varies each year and it actually decreases over the term. So the total expense is made up of the interest expense, which is exactly the same as it was under the operating lease, and then the amortization of the right of use asset. So for the operating lease, as Jonathan mentioned, the amortization of the right of use asset was essentially just a plug to get to that consistent straight line lease expense each year. But for the finance lease, the right of use asset is generally amortized on a straight line basis. And this will generally be straight line unless you think another basis is more representative of how you're using the asset. But overall, you can see that this difference in how the right of use asset is being amortized is really what's causing the overall differences in the expense recognition between a finance and an operating lease under 842. So for the finance lease then, the company would record this journal entry at the end of the first year with similar entries then throughout the lease term. So instead of recognizing the single lease expense, like for the operating lease, you recognize both interest expense and amortization expense separately. You can see that the subsequent accounting for a finance lease under 842 is really consistent with how you record a capital lease under 840. The main differences there are that you have to monitor for more reassessment events, such as a change in the expected lease term, and then also the treatment of modifications will be different when those occur. So that brings us to our first polling question. Make sure you answer this to get your CPE. So we want to know which accounting standards your company is following. So is that FASB, IFRS, GASB? Maybe you follow multiple of these, or maybe some other standards.
Right, and we're interested in this too because under FASB and IFRS, this is going to be fairly similar. There are obviously some very big differences, not the least of which is that there's only one type of lease under IFRS 16, GASB 87 following a very similar path. But a lot of our clients are all over the place in terms of which standard they will be following, but all of them are seeing some big difference in how they're handling leases. So let's go ahead and give maybe a few more seconds here, Chrissy, for people to answer the poll, and then we'll share the results. Okay, go ahead and close that for us, Chrissy, and then let's see what the results are. All right. Well, this is great. So it looks like we've got a 52% of the attendees on today's webinar are on FASB, and then a handful on IFRS, GASB making up about a third, and then some lucky few of you are on multiple accounting standards. You just get to do it all, and then a few others are on other, and I imagine some of that's going to be income tax basis or cash basis, which obviously brings on its own set of issues. Okay, so we'll go ahead and go to the next screen sharing, Chrissy, and I'll continue with the presentation, but thanks for answering that first poll question. All right, I think we'll ramp up the complexity just a little bit and do an initial measurement of an existing operating lease. So if you'll remember, our first one is a brand new lease, hadn't been accounted for under ASC 840 or our current lease standard, and so it was really just putting it on the books as if 842 had been around forever. But that's not going to be the case for most of us. Most of us are more nervous about the transition from 840 to 842, and so that's where this example is going to come into play. And so we're going to stick with the office building. And this is just another Uncle Cherry location, and so Uncle Cherry has another small existing office space, and it's currently under 840, and it's got 4 years remaining on the initial lease term. The initial lease term was a 5-year lease, which we'll see on the next slide here, but they've been paying into this lease for 1 year, and then they've got 4 years remaining. So the commencement date of this lease is January 1st, 2018, so before they adopted in 2019. And so the lease payments will go as follows. It's $31,000 for the first 2 years, of which they've already paid 1 full year. They've got $33,000 for the next 3 years, and then if they wanted to renew at the end of the initial 5-year term, they can go $35,000 as a year-to-year lease. But as in the last example, management is uncertain what they're going to do after the 5-year non-cancelable period, and so under 842, this would just give us a lease term of 5 years or 4 years remaining on this lease. The first lease had an incremental borrowing rate of 10%. We're switching this to 6%, and Michael will get into our borrowing rates, our discount rates here later on. Under 840, our classification was operating, and we had an initial direct cost amount of $500. Again, this was paid in January 2018. It's important to note that Uncle Cherry has opted to elect the package of practical expedients. And just because many of you may not be intimately familiar with the package of practical expedients, I think it's worth going over and reviewing that with everybody. There are many more practical expedients other than the practical expedient package, which I'm just calling PEP. There are many more, but this one in particular, we feel most of you are going to be extremely interested in adopting if you're under FASB. So there's 3 practical expedients in the practical expedient package, and so these are ones that we want to make sure you absolutely know about. It certainly makes the standard easier to adopt, and these will make things much simpler in terms of quantifying and reassessing certain classifications and whatnot. So the first is you don't have to reassess whether or not an arrangement is or is not a lease. This includes embedded leases. And so this is a very important one. The standard, the new standard ramps up the definition a lot in terms of what qualifies as a lease. It eliminates certain pieces. It introduces new aspects to things. And so the majority of leases will still be leases under 842, but we may see a lot more qualifying as leases that maybe hadn't under 840, and there are all sorts of complications that come along with that, and you can see some of our previous webinars where we discussed this. But under this practical expedient, if you determine under the old lease standard that you had a lease, you can continue with that treatment. You don't have to reevaluate all the contracts just to make sure, oh, maybe it doesn't count, maybe it doesn't count. You can continue as if it was a lease under 842. The second piece is with lease classification. This one may be even more important. Under ASC 842, the rules are different for if something is capital, which we're now calling financing, or if it's an operating lease. And if you adopt this practical expedient, you no longer have to reassess the classification of the leases under the new lease guidance. So if you had one as operating under 840 and you elect the practical expedience package, you don't have to reassess the lease classification. You're good to go treating that as operating. It just now still has to go on the balance sheet. Same thing with capital. It'll just now be switched to a financing lease. And the third one, and this one gets a little bit maybe not as much press as the other two, deals with initial direct costs. And this is an area where the treatment is going to change in terms of what qualifies as an initial direct cost. Fewer costs will qualify under 842 than they do under 840. And so there's a whole lot of detail that goes into that. But if you've been amortizing your initial direct costs under an 840 lease, you don't have to reassess which ones qualify, which ones don't, and do a lot of math to get you there. There's two pieces to keep in mind with the practical expedient package, and that is this is an all or nothing election. You have to use this to all leases. You can't pick and choose which leases this applies to, and you have to adopt all three of these practical expedients. You can't pick and choose. I want to do if it contains a lease and the classification, I want to eliminate the initial direct costs. You can't pick and choose. This has to be all three of them, and it has to go for all the leases. All right. So thanks for that little pit stop on theory. Let's get back to our example. And so just to refresh your memory, this was a lease that started in 2018. We have our payment schedule. We have a 5-year lease with 4 years remaining. The incremental borrowing rate 6%. And then I've highlighted in red the pieces that are affected by us adopting the practical expedience package. Number one is that we're not reassessing whether or not this is operating, and we don't really care whether or not all 500 of those dollars counted as initial direct costs under 842, because we're good to go with 840. And one quick caveat is, even if we adopt the practical expedience package, this does not preclude us from, if we were implementing something incorrectly under 840, we still have to correct it under 842. So you can't, wrap in errors of accounting. Those would still need to be looked at. So if you had made some mistakes under 840, the practical expedient package does not get you out of mistakes going under 842. All right. So our timeline, just as a reminder, is we're reporting as of 12/31/20, but for 12/30 or for 1/1/19 and over 2020, we're looking at this 2-year period. Here are the carrying amounts under adoption of 842. So you'll remember we started this lease 1/1/18. We've got two pieces that need to be looked at. One is the accrued rent liability, which we'll calculate here together in a second. And two are the remaining unamortized initial direct costs. So let's back into each of these numbers so we can all be on the same page with these. With the accrued rent liability, you'll remember the payment schedule is $31,000 for the first 2 years, $33,000 for the next 3 years. You just divide that by 5, and we've got ourselves $32,200. You'll remember in year 1, we only had to pay $31,000, and so our straight line rent of $32,200 minus the 31 in the first year leaves us an accrued rent liability on the balance sheet of $1,200. We've also got these unamortized initial direct costs. It's very simple calculation. You had it at the beginning of the lease at $500, and you divide that by the 5 years, and you expense $100 a year. So at the end of 2018 or the beginning of 2019, when we're adopting 842, we've got a remainder of $400 in unamortized initial direct costs. So by going through these balances, we can do a lot more now. So we know accrued rent, we know unamortized initial direct costs. Our annual lease expense, though, is going to include the amount of unamortized initial direct costs, which is going to be that $32,200 plus the $100. And the remaining $400 is going to be closed into the right of use asset and expensed over time along with the straight line rent. And this may become more clear as we look at the entries and the amortization table. The lease liability is very simple. We take the remaining minimum lease payments for the remaining 4 years, and we discount those at 6% or $112,027. And the right of use asset is fairly simple to calculate, but we take the lease liability, or the $112,000, we add the unamortized initial direct costs, we reduce the accrued rent for a net of negative $800. And this is essentially closing out the unamortized initial direct costs and the accrued rent into the right of use asset. So it's getting all the stuff off the balance sheet with the exception of the right of use asset. So let's take a look at the entry. So entry number 1 on 1/1/19, which is the adoption date of the new standard, we've got our right of use asset at $111,000. We're getting our accrued rent off the books and our unamortized initial direct costs off the books and closing all that into the right of use asset, and then we put our lease liability on the books. For our amortization table, it's very similar to the first example that we looked at. We've got straight line rent, and so that expense is going to be a single line on your income statement at $32,300. We've got our payment, which we're just following the payment schedule. In column C, you'll see the interest, and this is just reducing it by the effective interest method. The principal amount is just the payment minus the interest. And then, just as we saw in the first example, our right of use amortization is the expense minus the interest, and that's going to be the plug, essentially, like we saw in the first example, and that causes that right of use amortization to increase throughout the life of the lease. And then we have our entry that we can go ahead and post at 12/31/2019. And so this is reporting under 842 for the full year. We would reduce our lease liability by $24,090 just following that amortization schedule. We have our straight line lease expense at $32,300. We can reduce the right of use asset with that right of use amortization at $25,390, and then our cash is of course fixed with whatever the payment schedule is, and then we would follow that throughout the remaining life of the lease. What is going to come into play a lot of times, however, is this lease term being an issue. And so let's change the facts one more time. We've got the commencement date at 1/1/18 staying the same. Our lease payments are staying the same. We have these renewal options where at first it said management doesn't know what they're going to do at the end of the non-cancelable period. But let's say now management does know. We're reasonably certain to renew until at least 2025. We also know that this is going to cost us $35,000 a year as a year-over-year renewal. Our income and borrowing rate, the classification, and interest rate cost, all that's the same. The only thing that's really changing is our lease term. So let's go ahead and take a look at the timeline now. So we have the commencement date of the original lease at 1/1/18. The end date of the original lease was 12/31/2022, and so under 840, we had a 5-year initial lease term, and at the adoption date of 842, we had 4 years remaining at 1/1/19. What we're doing with 842 is the initial adoption as at 1/1/19, and under 842, that first example that we just went through, we had it as, there's only 4 years remaining, management is uncertain, and so we don't know what we're going to do after that, but we're not reasonably certain to extend. But then we changed those facts to say, now we are reasonably certain to extend to 2025. And so that ASC 842 lease term is really going to be 7 years remaining at the date that we adopt this lease. This is a critical piece of the new standard. And so what I have highlighted in green is those additional 3 years. And this is probably one of the biggest changes in the standard, other than just putting these things on the balance sheet, is the lease term. And this is something that your auditors are certainly going to take a look at, is if you do have all the lease terms just being the non-cancelable period, they're certainly going to ask you questions on any of these renewal options being reasonably certain to extend, most notably in the real estate world. And so I want to quantify the effect of this. And so under our first one, which just had 4 years remaining as of 1/1/19, we had annual lease expense of $32,300. If we use those other 3 years and management is certain to extend to 2025, that lease expense goes up to $33,457. The lease liability, you can see an enormous impact, as well as the right of use asset, you can see an enormous impact. It goes from 112 or 111 to 185 and 184. And so there's a big balance sheet impact just based on a 3-year extension of the term. And this is one of the pieces where, as an auditor, we're going to certainly look at this, because you can see the material effect this would have. This is just one lease, but you can imagine an entire portfolio of leases. It's certainly something they're going to view in detail. And so this is one thing that, as you're going through your implementation, these lease terms, just know that's going to be something your auditors are going to want a lot of answers for. All right. I've talked long enough. Let's let you guys do poll question number 2 here. And I'm just curious, where are you in the implementation process? Have you not started, but because you're still learning about the standard and you're educating your folks on kind of what this is going to take? Have you gone ahead and started the process, but maybe you're not very far along in it? You're just kind of at the beginning stages, quantifying your leases, finding where they're all located. Maybe you've already started implementation and you're kind of halfway through the process. Maybe you're almost done, or maybe you lucky few have actually finished your lease implementation process under 842. So let's go ahead and take a look. Chrissy, we'll give them maybe just 5 more seconds before we close the poll. Okay, go ahead and close that for me, Chrissy, and let's just kind of see where everybody stands and if you can post those poll results. Okay, great. So we got about 60% of you are still learning or haven't really started, and that could be for a lot of reasons. Maybe it's just not going to be a huge impact for you. Maybe you're nervous. Maybe you're new to the position. Maybe you're still trying to get buy-in from folks, or most notably, you're probably busy with implementing 606, and that's taken all of your resources. About 22% are started, but not very far along. A few of you are partially complete. Look at 5% being substantially complete, and then 2% are complete. So we got about 7% of you that are almost done. So kudos to you guys. For the rest of us, looks like we got a lot of work to do, and so we're certainly happy to help you with that. All right, we'll get back to the presentation. I'm going to hand it over to Jessica to take a look at initial measurement of a financing lease, or what we used to call capital leases.
So this example is how you would transition an existing capital lease to 842, where it's going to become a finance lease. So in addition to the office space, Uncle Cherry also has an equipment lease in place when the company adopts ASC 842. So I'm not sure exactly what kind of business this company's in, but they have a lease for a tractor, and it has 4 years left. So here are the details of this tractor lease. It started January 1st, 2018 with a term of 5 years, no renewal options. The company is paying $10,000 a year in lease payments, and at lease inception in 2018, the company's incremental borrowing rate was 6%. So when the lease started, they determined this was a capital lease. So they accounted for it as capital throughout 2018, and so there's a capital lease asset and liability on the books. So as Jonathan mentioned earlier, the company elected the practical expedient package for the office space lease. And since this must be applied to all leases, we'll assume that they're also using the package of practical expedients here as well. So as Jonathan mentioned, because of the package of practical expedients, the company doesn't have to reassess whether the contract is or contains a lease, doesn't have to reassess whether the classification of the lease would be different under 842, and there's no need to reassess any unamortized initial direct cost, since there is a difference now in that definition of what is considered an initial direct cost under 842. So because of this, we'll consider this lease to be a finance lease, and we'll include all existing initial direct costs without any further evaluation. So this is the same timeline as before. So Uncle Cherry is technically adopting the new standard on January 1st, 2020, but the date of initial application will be January 1st, 2019, which is the beginning of the earliest period presented in their financial statements. So as I mentioned, under 840, the company was recording this as a normal capital lease, and so they put the capital lease liability on their books at January 1st, 2018, when the lease started. So that liability was recorded at the present value of the future minimum lease payment, and then the corresponding capital lease asset was also recorded. So these amounts show what the remaining balances are of 1 year of normal capital lease treatment under 840. So here you see the same balances as on the last slide, which show the amounts on the books at January 1st, 2019, before they record the transition adjustment to 842. So then this next column shows the amounts on the book still at January 1st, 2019, but after they record the transition adjustment. So overall, you can see that since this was a capital lease, the lease liability stays the same when you adopt. The only thing that's changing is that the name of your capital lease asset is changing to right of use asset, and then any unamortized initial direct costs are added into that initial right of use asset. So to record the transition adjustment, the company would record this journal entry at January 1st, 2019. So this is just closing the capital lease asset and the unamortized initial direct costs into the right of use asset. So you can see that there's no real impact here. It's just moving the assets around to different names on the balance sheet. So then going forward, this amortization table shows your future accounting under 842 for the finance lease. And so this is assuming that there's no modifications or no reassessments needed to the lease. This is how the amortization table would look when you adopt. So as we discussed before, you can see that the right of use asset amortization is a straight line expense, and then your overall expenses, which is the interest and the amortization expenses, are decreasing over the term of the lease. So to record this lease then on an ongoing basis, the company would record this journal entry at the end of the first year, and then similar entries throughout the remaining term, just following the amortization table. So as we discussed before, for a finance lease, the interest expense and the amortization expense are recorded separately. They're not just included in one lease expense line like with the operating lease. And so these expenses can either be grouped with your other interest and amortization expense on the income statement, but they'll need to be tracked separately as lease-specific expenses for disclosure purposes. And so that brings us to our next poll question. So overall, what does your lease portfolio look like? Do you have mostly operating leases where you're the lessee, mostly capital leases where you're the lessee, a mix of operating and capital as lessee, or are you mostly a lessor? Or are you kind of all over the place? Do you have both leases as lessee and lessor?
Yeah, this is an important question to understand. I mean, obviously, we're focusing today on the lessee side of things, but we have plenty of clients that are almost exclusively lessors. And so there are some slight changes that maybe we'll get into on some future webinars. But let's go ahead, Chrissy, maybe give them a few more seconds to see. Or to answer the poll question before we close that. Oh, and just a quick CPE reminder, we do need you to answer, I think it's 3 out of 4 poll questions to get credit for CPE. All right, Chrissy, we can go ahead and close that and take a look at the results. All right, wonderful. So it looks like about half of you are primarily operating in a lessee capacity with operating leases. Handful of you have mostly capital leases, but the majority of you, it looks like, are lessees. And so what is that? 82% have either primarily operating or operating in capital. Got a couple of lessors on here, and then maybe 12% doing both. So this is really good information for us, for sure, just to kind of make sure that we're addressing the concerns of the crowd. Okay, very good. So let's go ahead and keep moving along. We are now going to move into Michael Hoos's part, and he is going to talk a little bit about discount rates and then go through a few examples of his own. Michael?
Thank you, Jonathan. So I've gotten a surprising number of questions on discount rates, and it makes a lot of sense because now that most leases, other than short-term leases, are going to be put on the balance sheet like current capital leases, the measurement of that right of use asset or liability is dependent upon a present value calculation, and so discount rates are particularly important. So with that being said, let's go into some of the details of what you're supposed to do to select a discount rate. And the first choice is the implicit rate in the lease. And so it might be actually stated and explicit, or it might actually be you have a cash selling price and you know what your lease payments are, and you can do the math to come up with your implicit rate. Then the next choice would be the incremental borrowing rate. And this is perhaps one of the biggest changes with 840 to 842 is that under 840, folks just use their general kind of cost of capital. Under 842, it needs to be a rate that would be charge for a collateralized loan. And so that's going to be a lower rate in general. And so some of the consultations that I've done, I've seen some folks who have, looked at their cost of capital, mix between debt and equity, things that aren't necessarily collateralized. And so they come up with a higher rate, which again makes it too low of a ROU asset or liability. So when you're thinking of your incremental borrowing rate, you need to use a rate that would be for a collateralized loan. But some folks don't have ability to obtain financing, and so the question becomes, well, if I don't have the ability to compute the implicit rate, or I don't have a incremental borrowing rate because I'm not able to obtain financing, what do I do? And so in those situations, you need to use the market rate for the lowest grade debt. And so that's going to result in a very high interest rate and a lower ROU asset and liability. And then still further, we have some private entities, that would choose just to use the risk-free rate because it's easier than, obtaining what the implicit or incremental borrowing rate might be. I would advise against doing that because the risk-free rate, by definition, would have the lowest interest rate, which would result in the highest present value and thus highest ROU asset and liability. So that's some information on discount rates. Let's talk a little bit about, get away from the theory and moving back into some examples and talk about a modification to a lease. And there's many things that could cause a modification to a lease, from, deciding that you are reasonably certain to exercise a purchase option or a lease renewal option that you previously originally had not believed was reasonably certain, to adding on new assets. And so the example that we're going to walk through now is going to be on adding a new asset to a lease. And so we're going to go back to our previous example with just your average building and with Uncle Cherry. But now it's January 1st, 2025. So we've, adopted in 2019, and we're about halfway through that 10-year lease. And if you noticed, we've also changed our name now to Uncle Cherry's Widgets and Now More Stuff, because we've grown. And because we've grown, now we're going to need to add an extra floor. And so we agreed to modify the lease to include an additional floor, but we're going to get a little bit of a discount because we're already a lessee at this building. And so that's an important fact to note, is that if we were just adding another floor at whatever the market rate might be, we would not have to go through all these different calculations that I'm about to show you, because we would just simply treat the new asset or floor in this situation as a whole brand new lease, and there'd be no need to really go through modification accounting because it would be at the market rate. But in this example, we're going to go through and have a discount rate. And so let's go through some of the facts. Again, we modified it about halfway through the lease in January 1st. The carrying value of the original lease liability at modification date is $53,000, and that's very important because we're going to have to true that up to what we think the new lease liability for the original floor should be. We have some new modified lease payments, and there's a 5% annual increase now. And the incremental borrowing rate has also changed. So we've grown bigger and we've become a more reliable borrower. And so now our borrowing rate has decreased from 10 to 8%. No modification direct costs. The estimated standalone price for the original floor and the modified floor. And the reason this is important information is because that's how we're going to have to allocate the new lease payments. We're going to have to allocate them between the original floor and this new additional floor based upon the estimated standalone price. And you might ask yourself, well, what is that estimated standalone price? It's beyond the scope of this course, but it would be the price that you would pay to purchase that portion of the contract. Not necessarily, obviously, to purchase the building itself or one floor in that building, but to purchase that element of the contract. And all other terms that might be pertinent are the same as the original to keep this relatively simple. So let's go through some of the math that we might have to do here. So the first thing that we would probably have to do is we would have to say, okay, what are my lease payments? And so we would calculate what all the lease payments are going to have to be under the modified terms. And again, we start off with the $2,100, which is the given fact, and then it increases 5% in this example, and that comes out to $139,000. Well, what do we do with this $139,000? Well, we have 2 floors. We're going to have to take it, and we're going to have to allocate it to the 2 floors, and we're going to do it based upon that standalone price. And so you see we have the original floor had a standalone price of $45,000. The additional floor had $55,000. The math works out really nice for this example, and that's a 45-55% split. And so you allocate the total payments, $139,000 that we calculated in the first table to the left. We allocate that in the table to the right to the original floor and the additional floor. And so you come up with the payments of $62,600 are allocated to the original floor and $76,500 or so to the additional floor. And then you calculate what that per month amount will be. And then you calculate using that the present value of an annuity. And so you see here I get $51,500 for the original floor as the present value under the new modified terms, and $62,900 for the additional floor under the modified term. So let's start with that original floor. What do we got to do with that $51,500? Well, we know previously that the carrying value of that liability for that original floor under the original lease was not that dollar amount. It was $53,314. And so we simply just have to true that up. And so we would see a reduction in the liability of $1,800. And so that journal entry would be pretty simple. You would just go ahead and you would debit the lease liability to decrease it by $1,800, and then you would credit the ROU asset by $1,800. And now you've trued up that original floor. But we had this additional floor that we need to record as well. And so similar to a just plain old simple lease, the entry that we would use to record the additional floor would simply just be a debit to the ROU asset for $62,000 and a credit to the liability for the same amount. And that would be how we would record the modification. Now, there's lots of things that could cause a modification. I think it might be worth going over all those different things and the scenarios and the different nuances to the potential modifications. So if you had a change in a lease term, you would have to remeasure and reallocate between lease and non-lease components. That's true of all types of modifications. And then you would have to revise that lease liability, and you would use it with the most recent discount rate. So if you have a change in the lease term, that's a pretty significant change. You think you're going to perhaps exercise a renewal option that you previously had not. And so you're going to have to update that discount rate because it's a big enough change, which means that you're going to have to adjust your ROU asset. And that also means that the lease classification might change, that second to the last row there in this table. And of course, if the lease classification changes, you're going to have to adjust how you might recognize your costs going forward. But there's other reasons why you might have a modification. For example, you might decide that you're going to exercise a purchase option that you previously thought you were not. And if you see here, you treat that exactly like you would a change in a lease term. You would have to reallocate between non-lease and lease components. You would update your lease liability based on their discount rate. You would have to adjust your ROU asset. You might have to adjust classification, that kind of thing. But then there's 2 other reasons why you might have a modification. For example, maybe you are having a change in the estimated residual value guarantee. Oh, looks like we might, have to pay less or pay more based upon how our asset is depreciating. And if you see, it's pretty similar to the other changes, except that the second row there, the remeasure your lease liability, you would do that, but you would do it at the original discount rate because it's a change in estimate. So you're still going to use the facts and circumstances outside of the change in the RVG value. You would use everything the same like the discount rate. And because this is a change in estimate, if you notice the second to the last row, you would not have to change the lease classification. So if you had previously had it as operating or finance, it would stay operating or finance. You would simply just adjust your ROU asset. And of course, that means you would not have to adjust how your cost is recognized going forward because it would still remain the same type of classification. And the exact same treatment would happen if there's for example, resolution of a contingency, if there's like perhaps maybe some sort of increase in fees or something like that you might have to pay. Again, think of that as a change in estimate. Contingency, you had your original estimate. Your RVG, you had your original estimate. You're just updating your estimate, so you wouldn't have any kind of classification change. And so that's pretty much what modifications are all about. I'm sure you're going to have a lot of those. And with that, let's go ahead and move into our fourth polling question here, which is, which part of the calculations do you believe are going to be the most challenging? Ensuring that all leases have been identified, your completeness, determining the appropriate lease term, and which I think is a very important thing to do because that will determine your ROU asset and liability, determining that correct discount rate, or determining the classification, or accounting for modification.
Yeah, we've gone over a lot, and there are more. We probably should have put a miscellaneous, or just the whole thing, all of the above. And while you're answering that, I just want to mention, I really appreciate all the questions that have been coming through. There are a lot, and so we're trying to get to a lot of them, but if we're not able to, we'll reach out, and if there are themes to a lot of the questions, we'll do our best to maybe write a blog post or something else, or reach out to you individually if we can. All right, Christy, we can go ahead and I think close that poll and we'll take a look at the results. All right, so it looks like, Michael, you win. The accounting for modifications looks like to be in the lead for our group here today, followed by just making sure we've got a comprehensive lease portfolio and finding all of our leases and making sure they've all been identified, and then followed closely by the correct discount rate. And so there are a lot of other pieces that we could have put in there, but this is really helpful information, and clearly there's a lot that goes into the lease standard. And in our previous webinar, and Chris, you can go ahead and show the slides again. In our previous webinar, we talked a lot about not using Excel for this, and I hope that you can maybe see why Excel would be a bit of a challenge to account for all of this, with just not the least of which being formula errors, but just the amount of things that need to be tracked and kept up to date and modified throughout the life of the lease can get a little bit rough. And so Michael and Jessica and I we've looked at so many software vendors, and we've developed our own pieces in-house to maybe help with tracking leases or even figuring out how to audit these things. And so we figured we'd show you kind of where we are with lease maintenance. We do have some software vendors that we feel are really good representatives and can help as great partners for you. We've also got one in particular that we are using as a service that we can help with lease maintenance for you. And so we've got this one that we're showing up on the screen is a screenshot of what it looks like inside our lease maintenance provider. And so, of course, what we're able to do with you would depend on whether or not you're in a test client. So if we serve as your auditor, obviously for independence reasons, we are unable to do certain pieces, but we can still at least hand some assistance and some guidance to helping you get through adoption. If we don't do any type of a test function, obviously independence isn't as much of a concern, and so we can do a lot more. Either way, we can provide access to this software right here that you see on your screen. So I just have on this, on examples, or the examples that we went through today. So you can see the average building, the additional floor, the original floor, the tractor, the other additional office space. And so this is where you would hold your actual leases, like a PDF copy of the leases. You can input your practical expedients or any other of the policy elections you've made into the software. You can track location and company. You can obviously have a view by the lease end date, and so on and so forth. You can track your assessments or reassessments all throughout here. And then once you've got them all input, which I don't want to minimize, that's by far the most difficult part of the standard, is just getting them all into a system. What's really nice about the software right here that we're looking at is the reporting features. And so with that, you can see we've got, for our 2019 and 2020 reports, we have the ability to run journal entries. And this is not just the transition entries. Let me get my little spotlight. This is not just the transition entries, but the journal entries for the ongoing amortization of the right of use asset and liability, as in addition to the income statement entries. You can run your amortization schedule as of certain parts of the year if you want to see where you stand, or tie that back to your journal entries to kind of show your math. It will start to look at the footnote disclosure. It won't do the entire footnote for you, of course. It can do for 842 or IFRS 16. We are working with them to develop a GASB 87 module, but that will be a while. And then you can just export all of the lease data right there for you too. Let me go ahead and show you a little bit about what each of those reports would look like. And so we're crunching the data. And then out of the onset, here is our journal entry report. And so you can see this is just for January. You can enter in your own GL numbers at the beginning of, or during the input stage of everything, and it'll tell you which GL account to book each entry to. Here's a quick peek at the amortization schedule and what that would look like for you, as far as if you needed some support or tying it back or giving something to your auditors. And then lastly, here's a peek at the disclosure side of things. And so it will quantify a lot of those disclosures that are difficult. It also has the functionality to be able to give your auditors view-only access to your lease portfolio. And so some of the audit trail will be a lot easier for them to follow. I know we covered a lot today, and but there is so much more that we could do. And so on our website, we've got a lease accounting webpage dedicated to this, where we post things from time to time. We'll post the recordings of our webinars. You just go to our services page, the assurance, and then right under there is our lease accounting page. And once you get there, you will see a series of blog posts and information and links to our webinars and some contact info that if you needed some assistance or would like to reach out to us with other questions, we are more than happy to assist. I've just listed a handful of the webinars we've done in the past and certainly many more to come. With that, I think we've reached our hour, and so I just want to say thanks again to all of you for attending today. Thanks so much for the questions. For the ones we didn't get through in the chat here today, we'll do our best to kind of filter out and get back to you individually when it makes sense. And if you can't wait, you're welcome to reach out to me or Jessica or Michael on the email addresses you see on the screen. And I think that should do it here for us today, everybody. Thanks again for tuning in. I hope everyone has a great day, and we will see you next time. Thanks, everybody.